Welcome to Taking Stock for the week ending the 14th of November 2025. I'm Kien, Head of Research at Stock Doctor, and joining me today is our equities analyst, Charlie Song, to stream to you all things share market. Welcome back again, Charlie. How are you today?
Good, thanks. And it's great to be here, Ken.
Great to have you on board, especially as we head towards the end of the year. But as always, the information we provide is of a generic nature and doesn't take into account your personal situation or needs. Shares are volatile, and any past performance figures aren't a reliable indicator of future performance here. But this week, Charlie, we've begun to see some volatility emerge across the share markets. While the US federal government shutdown has practically ended, its impact on data and policymakers that use to make that decision is still uncertain, and that has dented expectations for rate cuts.
That's right. And here in Australia, the picture is actually quite similar.
Mm.
The unemployment rate unexpectedly fell to 4.3% after the previous month saw an increase in that unemployment rate. And that signals to us that the labor markets remain stronger than expected. That has pushed expectations for rate cuts further out, weighing on interest rate sensitive sectors like REITs, technology, and consumer discretionary.
Yeah, and that's certainly having some effect on some of our star stocks. But talking about star stocks, let's turn to a few announcements this week. Jumbo Interactive, Australia's leading online lottery reseller and software provider. At its AGM, the company reported a steady start to financial year 26. Lottery retailing, it grew 5.2%, and the SaaS business, that revenue increased 8%, while managed funds in the UK and Canada also saw double-digit growth. But operationally, the company continues to track quite well, and that should provide confidence that the company could meet its return on equity target at 38%.
Yeah, but despite that, the share price has come under pressure in recent weeks and months. The key reason we think is maybe because there is a big change in Jumbo's capital allocation framework, as well as the areas they're looking to invest in. The first thing we should point out is that Jumbo has reduced its dividend payout ratio quite sharply. It's going from 65 to 85% of net profit after tax to only 30 to 50%. That's pretty much a halving in the dividends it expects to pay out to shareholders. The reason why it's lowering its dividend payout ratio isn't because it's making less money, but because they're looking to divert some of those earnings towards acquisitional activity, especially in the UK and the US. Recently, we saw the purchase of Dream Giveaway USA, which is a prize draws business similar to lottery, but slightly different in the US. Even though FY26 continues to display a healthy yield above the market, we think income-focused investors may need to have another look at this company.
Yeah, definitely, Charlie. And that healthy yield, though, means that it's still retained as a star income stock for now. But I noticed that the short interest on the stock has started to rise and is now close to 5%. So a few fund managers don't believe the story so far, but management is prioritizing to paying down their debt, also allowing that capital flexibility. And also allowing them to scale internationally as well. With the stock trading at a significant discount to fair value, Jumbo does look like a good long-term opportunity for investors from here. But let's move across now to financials. Our attention towards the banks, Charlie, with the reporting season for the banks ending this week. We're starting with Commonwealth Bank. The company delivered quite a steady September quarter update with cash profits actually up 2% year on year, but the share price reacted quite poorly. Why was this the case?
Yeah, it seems to be a combination of a few factors.
Mm.
Firstly, CBA's update indicated that growth was challenging whilst its valuation remains elevated. CBA hit a mark where it was known as the world's most expensive bank in history. Now, the decline in its net interest margin implied that the bank continues to face strong competition amongst loans and deposits, together with rising costs.
Yeah, that appears to be a key theme across the banking sector there, Charlie. But CBA, the bank trades on a modest, fully franked dividend yield at around 3%. And any further weakness, especially in the share price, could represent opportunity here, especially given that it will be the bank to go ex-dividend in about 3 months. Meanwhile, ANZ, that's interesting. It outperformed its peers, even though its cash profits actually fell around 14%.
Yeah, the positive reaction seems to reflect expectations and an improved outlook.
Mm.
Under its new CEO, Nuno Matos, ANZ laid out a clearer long-term roadmap in which it wants to simplify operations, continue its integration of Suncorp, and lift productivity whilst expanding returns, all while the dividend yield is expected to remain steady. Plus, other risks such as regulatory scrutiny from the bond trading scandal seems to now be behind them.
Yeah, quite interestingly, the bank is currently on a payout ratio of around 88%. But looking forward, as you suggested, Charlie, that dividend yield of 4.5%, and that payout ratio is expected to decline to 68% on the back of that large uplift in forecast earnings growth. That should help the dividend become or be sustainable. And turning our attention now to the corporate calendar for the week ahead, business management software company Technology One. They are expected to release their results on the 18th of November. Also, late last week, we did remove global logistics business WiseTech from our star stock universe. And that was on the back of elevated governance and also execution risks associated with its latest acquisition. So please refer to our commentary for full details there. In under the microscope this week is Aristocrat Leisure, one of the world's largest gaming technology companies. Aristocrat, they design poker machines. They design it for casinos and also operates major digital and online gaming platforms. Now, their strategy has been to expand beyond physical machines and build a much larger digital ecosystem. And Aristocrat, they delivered quite a strong full year result, slightly beating market expectations at the NPAT line. But despite the good headline numbers, the share price fell sharply on the day, Charlie.
Yeah, it seems like investors were expecting more out of the result.
Mm.
Most of the line items seem to be in line with consensus figures,
Mm.
especially the key figures, revenue growth and game machine sales were pretty much exactly as analysts expected, but not ahead. So I think investors in general were hoping for something better out of Aristocrat, and that was why the share price fell.
Yeah, it was quite interesting there, Charlie, as well. Markets will also focus on the slower momentum in the online gaming division. While it's still growing, the pace wasn't as strong as investors had priced in. And since online gaming is expected to be Aristocrat's biggest long-term growth engine, any wobble there tends to trigger an outsized share price reaction. Added to that, though, you also had higher than expected operating costs, especially in R&D and digital investment, and short-term profit growth didn't look quite as strong once you dig beneath the surface there. So interesting. But from a valuation perspective, the stock does trade at roughly about 20% discount to their fair value, or 21 times forward earnings. The market is factoring slower online growth, increasing competition, and also the uncertainty around regulation in real money gaming, though. But there's also that risk that investment heavy digital expansion that may continue to pressure margins in the short term.
Yeah, but these risks we think are quite manageable. Aristocrat remains a pretty high quality business with attractive capital light growth and strong cash generation. Its return on equity is forecast to be sustained, and that's supported by recurring digital revenue, a large installed base of machines, and ongoing product launches. The recent pullback may present an opportunity for those with a longer time.
Now, for question of the week, with the bank reporting season over, a few of our investors, they want to know which banks did well and which performed poorly, Charlie.
Yeah, before we answer that, a few themes did stand out. Although earnings were generally stable, cost pressures and margin compression remain challenges. Second, credit quality is pretty healthy throughout the Australian economy, although there are early signs of stress emerging in business lending. And finally, all banks maintained or increased their dividends, but the growth outlook does remain benign.
Yeah, definitely. From a dividend perspective, those dividends look sustainable given the economy is still moving along quite nicely. But on the back of this backdrop, though, let's step through some of the banks one by one, starting with Commonwealth Bank, the standout bank operationally. It does have the highest return on equity, best technology, lowest bad debts, and strongest retail franchise. No wonder it's trading at a premium to valuation at around 25 times earnings now and a dividend yield near 3%. The stock does seem to be priced for perfection.
Yes, and next company we're looking at is Westpac.
Mm.
That Westpac has delivered a reasonably solid result. Cash earnings were down 2%, but the dividends were steady, with business lending momentum improving. The real challenge here is costs. Again, its multi-year Unite transformation program has got some execution risk, and the progress has been slower than hoped.
Yeah, very interesting there with Westpac. But moving on, what about National Australia Bank or NAB, which produced quite a flat earnings result? Very similar dividend yield to Westpac at around 4%, fully franked as well. But NAB's key strength is its market-leading business banking franchise, which provides diversification away from those mortgages. However, that comes with higher credit risks and rising bad debts this period as well. So the capital ratio, it's lower than the other banks, but is expected to lift after this MLC sale. So dividends appear well supported with strong capital buffers in place.
Yes. And finally, ANZ, the most interesting result this season. The new CEO has laid out a clear strategy, simplify the bank, integrate Suncorp, and rebuild profitability. ANZ trades at the most compelling valuation and offers a partially franked yield close to 4.5%, the highest of the majors.
Yeah, very interesting, Charlie. So to summarize, ANZ does stand out as the higher risk, higher reward option with the strongest growth outlook. Also, very solid result there. CBA is the most profitable bank, and if the price moves lower, that could represent opportunity, especially given that they will be the ones to go ex-dividend in around 3 months. You've got Westpac. They had quite a clean result, but do face higher costs and execution risk as they want to catch up with their technology upgrades. And then, of course, lastly, National Australia Bank, NAB, they appear to be the weakest link this reporting season, facing cost pressures together with rising bad debts across their business segment.
Yeah, that said, the environment does remain supportive of bank dividends into FY26. If you have any follow-up questions or want to discuss how any of this impacts your portfolio, please reach out to us or join our next Lincoln Live session.
Yeah, that'll be on Monday. And also, just a reminder that as part of the Prime Financial Group, we do offer a wide range of services, including wealth management, self-managed super fund administration, and also accounting, as well as access to alternative and property investment opportunities to help diversify your equity portfolio. You can explore all these on the Prime section of Stock Doctor. And of course, if you have any friends or family who might benefit from Stock Doctor, please feel free to share us with them. We continue to grow through our members, and we continually and genuinely appreciate your ongoing support. Until next time, have a happy, healthy, and prosperous week ahead.